Following the big drop, gold is now testing key support at around 4,000 level. Can it bounce back from here? Hello everyone, my name is Fahad Razakzada, market analyst for City Index. Following yesterday's big drop in gold prices, we've seen a continuation of that move today, meaning that gold prices have pulled back around 8% from its record highs hit on Monday. The sell-off has been quite abrupt. The reversal happened when gold prices took out this area of price support at around 4,200, where it had bounced previously on a couple of occasions. But the move below that triggered stops, and that in turn caused the selling pressure to intensify, causing the market to drop quite sharply. And the selling continued for the second day, where it's now finding itself testing this area of support, or potential support I should say, at around 4,000 to 4,022 to be precise. This is where we have the 21-day exponential moving average converging with the base of the prior breakout, and a bullish trend line comes into play there as well. The bullish trend line has been in place since middle of August or late August. And if we close below 4,000, that would be a bearish technical development in my view. However, for as long as we hold above 4,000, I think we could see gold consolidate for a few days before potentially starting a new leg up. But let's see what it does rather than trying to preempt the move given how fast gold has fallen in the last couple of days. So this area is very important. Keep an eye on it. The line in the sand for me is at 3,944, this low right here, which was the most significant last low prior to gold breaking higher. So that level needs to hold because if we were to go below it, we will then have created a lower low, in which case we could then see further technical selling below that level towards 3,900, 3,800, who knows. But for the time being, as I said, keep an eye on the 4,000 level, where we could potentially see a bounce from. Following the release of weaker than expected UK CPI report this morning, we saw the cable drop to near the 133 handle. It got to as low as 133.05 before bouncing back. As I mentioned in my report, I didn't expect the selling to persist because of my views about the US dollar being bearish because of the ongoing weakness in US labor market and expectations for 2 more rate cuts to come this year. And with the government shutdown continuing, now it's the second longest shutdown ever. This means that we won't have much in the way of official economic data to look forward to, although CPI will be released on Friday. The BLS has confirmed. That could be the trigger behind a potential dollar weakness. Who knows, if we see a weaker print, it could be the case. But more to the point is concerns about the US-China trade relations, which remain at the forefront of investors' minds, and anything can happen in that regard. So with the dollar coming back a little bit in the last couple of weeks, I think the upside is going to be limited from here, unless the government reopens and we see the release of stronger than expected US data to raise some doubts over the Fed's rate cuts in the coming months. But unless we see that, I think the weakness in the US dollar is going to persist for a while yet. And that's why I think the cable is going to be limited on the downside. But we do need to see a bullish trigger from a technical point of view to turn bullish on the cable once more. And for me, that could be in the form of a potential break above this area of resistance between 133.70 to 133.90. This area was resistance and support in the past, so if we go back above it, that could be a short-term bullish trigger. But the underlying trend is consolidation, really, isn't it? We have seen a range-banding market, not just in the cable, but across the FX markets. With that in mind, the next area of resistance I mentioned is this area. Above that, if we get above it, then 134.70 to 135, this is shaded region, will be in focus next. And then above that, we could potentially see a run towards the range heights, but we'll cross that bridge if and when we get there. For now, this is the most important area of resistance to watch, between 133.70 to 133.90. On the downside, 133 is the key level of support. We have seen a bounce from around that area today. We've had several attempts to break below this area in the past, most recently at the start or middle parts of October. As you can see by the wicks of these candles, we didn't close below it, which shows that support is strong there. And previously in early August as well, we tried to break below, but that was a short-lived breakdown before price recovered that area and rallied. So 133 is very important, and therefore if we close below it in the coming days, that could potentially pave the way for a run towards the range lows around 131, 132 area, where we have previously bounced a couple of times from. So those are the key short-term levels to watch on the cable. Consolidation is the name of the game in the euro-dollar currency pair, which has been quite frustrating to trade, really. And that trend may continue for a while yet, given the ongoing government shutdown in the US and the neutral tone from the ECB policymakers of late, owing to the drop in inflation and interest rates being quite low now in the Eurozone. So I think the interest rate cutting cycle is nearly done, if not over yet, in the Eurozone, and that is providing some support for the euro, while weakness in German data has caused the single currency to weaken a little bit in the last couple of weeks or months, I should say. But the underlying long-term trend remains arguably bullish still, given the fact that the Fed is on a cutting cycle still, with 2 more to come this year potentially, and 1 more in 2026, in the first quarter of 2026, I should say. So in total, I think we'll have 3 rate cuts in the next several months, which should put downward pressure on the US dollar. All else being equal, of course, a lot can change. But as things stand, I think that's the way I'm looking at the dollar. I don't think this recent dollar strength we've seen is going to hold. And for that reason, I think the euro dollar is going to find support on the dips, which is precisely why I'm looking for a potential bounce around current levels. But to turn technically bullish, we'll need to see a clear reversal sign on the euro dollar. And for me, that could be in the form of a break above short-term resistance at 116.50 or more, to the point a break above the bearish channel that the euro dollar is currently stuck inside. Unless and until that happens, taking it from one level to the next makes the most sense to me when trading the euro dollar. Don't forget to like and subscribe, and for more market updates, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.